With Brexit negotiations heating up, many clients are asking how they should be positioned on sterling trade. Well, we're taking a look now at the most commonly traded cross, sterling dollar or cable. Ron William joins us now from RW Associates. Ron, welcome.
Thank you.
Why cable? Why cable particularly?
Well, the cable is the currency of choice for most traders and investors, but also on a technical basis, there are important cycles that I've been following on the pound, which is why I tend to look at it against the dollar.
Okay, well let's take a look at the charts you brought along. You brought along 3 charts for us. The first one is an hourly chart. So these are candles that depict hourly movement. So we're looking at quite a short time frame, aren't we?
Yes, we are, and yet within a very short time frame, in basically a few hours of just a few days ago during the Brexit talk, we had a whipsaw two-way volatility price action on the pound, which basically took the pound several handles up, two big numbers back up, resuming the uptrend that has been in effect on this chart for several weeks. And that created a big short squeeze in the market. So there were people quite bearish going into the Brexit talks looking to short, and those positions were taken out, and that created the big violent reversal back up, but resuming the positive uptrend on the back of fairly lukewarm sentiment.
Technically, can you give an explanation as to why there was this drop and then the sharp increase in trade on the upside? I mean, it does coincide, of course, with I think the sort of the tacit agreement between the two sides that there is a financial settlement that looks to be in a sort of a ballpark discussion area, doesn't it?
Well, no one likes uncertainty, and then so I think the more information comes out, that tends to give further support to the market. Also, there's that famous phrase, sell on the rumour, buy on the fact, and potentially this is what actually happened. They speculation that things were going to get from bad to worse, and in the end, the fact that there was some kind of formal divorce agreement being formalised, at least in the early stages, lifted the market's spirit higher.
Yeah. Before we move on from this chart, I just want to bring it back up again. The Brexit whipsaw, the box you've got there, where we saw that low print there of 132.20. If sterling was to come back and test that and break that, does that wipe out any of the upside? Is that a point you're looking at to say your trade turns around? Well,
this is really important for traders, investors, or just people looking at the markets in general, to look at these psychological levels as emotional levels in the market. And so because it created such a big volatility signature in the market, we should see a potential break back beneath that level as a reversal of that sentiment. So 132.20 will be a risk level on the downside in the very short term on cable, and if that were to happen, then it's likely to be back at the lows thereafter. But before that level, we do have 134.10 and 132.70 as initial support levels based upon the probability distribution on the chart.
Yeah, as you said, I mean, these are hourly candles, or yeah, these are candles, so it only goes back to the beginning of November. Let's take a look at the second chart, which brings in the daily bar chart, which gives us a longer term picture.
Yes.
And I think you can see quite clearly this uptrend, this channel that we've been in now since the flash crash lows of 118 back in just after September last year.
Yes, and that's 118 on my chart platform. It varies across data provider to data provider because the spikes were so vicious back then. But essentially, it doesn't negate the fact that we've been in a one-year uptrend since. And I think this is something that people are struggling to acknowledge, just because it has been a difficult uptrend. I mean, it's been a few steps up, several steps down. So it's been challenging for some to trade. But technically speaking, it's still an one-year uptrend, and was confirmed based upon my medium to long-term signals. The two moving averages I used, the 50 and the 200-day moving average, which is actually widely used in the market. They produced a golden cross signal back in May this year, and that was very strong signal that the market was likely to continue high. Of course, what we need to see thereafter are new high breakouts, consecutive new high breakouts, and we saw it, but it was very grudging price action to date. And then, of course, we did have the breakout, which later on turned out to be a false breakout in September, and
to 136.60.
To 136.60. If we break back above that, then that does suggest that it was false before, but now's the real thing, and we could get the move up to 143, which is ultimately the be-all end-all of this trend channel. It produces a minimum price objective MPO target to 143, and that would be a basic scenario for the upside in the coming weeks, maybe into the new year.
And if it fails at the 136.60 again?
Then the flip side to that would be a move or mean reversion back into the long-term 200-day moving average, and that is currently at 129.20. So that's the dark blue line on the chart there. Keep in mind we also have various levels in and around. We have support at 132.40, which again is coming in from the probability distribution that I drew there.
That's on the far left-hand side of the chart,
on
isn't
the
it?
far left-hand side, but with an arrow going to the right. And then on the very upside, there is a pivot point that I do want to highlight below the 143 target, which is the midpoint of the Brexit cliff drop June of 2 years ago, and that is at 141.30. So a lot of people tend not to go back into history, but again, going back to those emotional signatures in the market market does have a psychological memory for these important events, especially something like Brexit. And so 141.30 will be a key pivot juncture.
Yeah, talking about going back into history, I know you like doing historical analysis, don't you? You look for cycles, and you said at the top of the interview about cable providing you with these cycles. And I know that your third chart, you've got this cyclical recurrence. If we can bring up the chart, we can take a look at the 8-year cycles that you've been following now since the middle of 1985, middle of 1980s.
Yes, well, to quote Mark Twain, history doesn't repeat, but it does rhyme, and certainly we get the time repetition in terms of this 8-year cycle. But of course, each time the economic rhyme has been different. So just a disclaimer there that there are different events that happen at each of these junctures, but the time pattern is the same. Plus or minus some kind of deviation. And for me, the confirmation of the 8-year cycle bottom being in place now was back a few months ago in May, as I just mentioned on the previous chart, when we had that bullish crossover between the medium and long-term moving average. But since then, we've had new high breakouts. Yes, it hasn't been a clear line recovery, but still the signals are in place, and we should be watching this cycle as we speak, because this is the big picture suggesting that the pound is rising from the ashes. It isn't just overbought signals on the short term, as many of my peers have been saying to me. And also, potentially the invisible hand of market forces doing its thing. So, despite Brexit, despite Bank of England, despite all of those external factors that do matter, it could just be very cheap levels in the market, and for that reason, buyers are buying.
Yeah. Staying on this chart, you've got that target there of 150. On the previous chart, you've been looking at 136.60 and then 141.30. What would take it to go all the way up to 150? Because clearly it's got to break that 141.30 first of all.
Yes, I mean, step one before step 2 and 3, and certainly that the higher levels, higher targets would be back to the Brexit high of 150 or 150.22 according to my chart. But either way, it would be 2 big figures higher, and certainly that would be a best case scenario in the medium to long term. But like I say, we still have to get to step 1 first, make a new high breakout above 136.60, and then into that minimum price objective at 143 before we talk about high levels. But I thought, since we're looking at the long-term chart, it's maybe important to keep that target in there as well.
You mentioned small steps first of all. Let's bring up the first chart again, because I think it's important to look at how we trade this, because the all-important stop loss needs to be put in place. If you're going to go long this is the first chart you brought along, which is the intraday hourly chart. Where would you place your stop, bearing in mind where we are at the moment and where the recent low was at 132.20?
Well, stop management all depends on when we get into the market too, and of course our risk profile in the first place. But I would say trailing stops, and perhaps tight trailing stops, would be a good strategy for now, particularly with this two-way volatility that we've just experienced, which has been quite painful for those certainly who got squeezed on the short side. But often we must also keep in mind that with such potential upside to profit from, it is equally important to let the upside, let the profit side run. So keep a tight, risk side to the trade, but to really just keep those upside targets wide.
Ron, thanks indeed for joining us.
Thank you.
With your look at sterling, and that is the case. for long sterling and the position that Ron was talking about there, looking for a first break at 136.60 on its way up.